Pankaj Tibrewal, who now joins in on the show to share his outlook on the markets. Pankaj, good morning. Let's understand how you're looking at the texture of the market at a time when we've seen a complete reversal in the trend. People were touting this as, disappointing budget, and the markets adversely reacted Saturday. And 4 days later, we've been doing nothing but gaining traction on the upside. What have you made of the recovery that we've seen?
Good morning. I think for the last 1.5 months, clearly market are showing signs of early broad basing. Mid-cap and small-cap indices have outperformed Nifty over the last 1.5 months. And now on a 6 months basis, the broader market is clearly outperforming Nifty. So if markets are any lead indicators, it is showing us that the worst on the economy is behind us. As far as your question is concerned, I think the Saturday's reaction, in our view, was an overreaction to the budget. It was more, I think, a reaction to Friday's sharp decline in Dow and the expectation that when Chinese market opens on Monday, we would see a sharp cut as well. So I think Saturday was somewhere lying between last Friday and Monday, and we saw a sharp reaction. I think budget over the years have become a non-event. I think a lot of things which needs to be done to revive the economy lies outside the budget. For example, our view is that the biggest reason for the slowdown in the economy has been the credit crunch or the credit transmission to the economy. In the first almost 10 months till 31st of Jan, when the data is available, the shortage of credit is to the tune of 5 lakh crores compared to the previous year. And banking institutions have together only lent about 2 lakh crores odd to the entire economy. We believe that at some point of time, the interbank liquidity, which is quite high at 3.5 lakh crore, and banks are today borrowing at about 6.25 in terms of deposit and parking with RBI at 4.85%, carrying a negative carry. We believe that this behavior over the next couple of quarters should start changing, and banks should start taking some risk and lending to the actual economy. If that starts happening, I think the GDP growth, which has been subdued for almost last 4 to 5 quarters, starts showing signs of recovery. But mind you, it will be a gradual recovery over the next 3 to 4 quarters. The second, I think, very important and positive factor in the economy has been the rural economy. The Rabi season has been extremely encouraging. The sowing has increased by almost 7 to 8%. The product prices are also high. So it means better farm income and better income for the farmers going ahead. And we believe that this is a very important trend after almost 4-5 years. The CPI print shows a food inflation of 12%. It's not sustainable because there will be policy responses from crops like onion, garlic, and so on and so forth. But even if you normalize it to 4-5%, it will be much higher than the last 4-year average of 1.5-2%. So an engine which has been down and depressed for almost 3 to 4 years starts seeing signs of revival. Third, the less appreciated fact has been the best asset class of last 1 year has been gold. Our back of envelope calculation suggests that Indian households are richer by almost 15 lakh crores. We may not think about wealth generation in form of gold prices going up, but in rural areas, gold and land are the two main asset classes. And I think at some point of time, this will aid consumption with a lag. So what we believe is that the worst on the economy is behind us, and over the next 3-4 quarters, directionally you should start see economy improving, and gradually we should move towards 5.5% GDP growth in FY21. And in our view, this is started to show in the markets. And we believe that over the next 18 to 24 months, the broader market should outperform Nifty in a significant manner.
Okay. And in that broader market recovery, Pankaj, where do you see recovery kicking in the first? What are the pockets of interest where you think it's worth investing in within the mid and small caps?
So across the, I think it's more bottom-up stock picking. Last 24 months have shown us that even in this tough environment, companies which have done the right things, grown their earnings, no corporate governance issues, have been disproportionately rewarded. I don't see that trend changing. Rather than sectoral themes, I would bet more on bottom-up stock picking opportunity. We believe that specialty chemicals is one where we have been positive for almost last 3-4 years. Another theme which we believe is started to play out, and it could be a multi-year theme in India, is that globally, if you look at, and there was a recent survey done by a global sell-side firm saying that about 3,000 companies globally are looking to shift a part of their supply chain from current location, which is China. And if that's the case, the preferred locations are Southeast Asia and India. We believe that this investment cycle revival will be very different from what we have seen in the previous last 10-15 years, and it will be led by global corporations setting up shops in India, and we provide a large local market for them. What we have seen in electronics and what we have seen in specialty chemicals is just the start, and many other sectors should follow. So our thought is that companies which will be catering to the global corporations will also be a very interesting idea to look forward for. The third, I think, is capital goods, cement, pipes. We believe that if there is any domestic recovery, these companies will gain disproportionately. Another theme which we are playing in our portfolio is that of consolidation. The biggest message of this cycle has that the survival of the fittest. In every sector, we are seeing a huge consolidation playing out. In telecom, there were 16 players, now down to 3. In cement, top 10 guys used to be 35% market share. Now they are more than 60% market share. In real estate, there were 1,530 builders registered at the time of RERA was introduced. Now that number is down to 620. We are seeing huge consolidation in aviation. We are seeing huge consolidation in banking and financial services. So that is another theme which is reflecting very well in our portfolios, that the guys who will survive this cycle will become very large in the next 4 to 5 years. So these are some broad thoughts which we are reflecting in our portfolios, and clearly we believe that it will be a bottom-up stock picking approach which will be rewarded in the coming times as well.
Some of the sectors that you would be bullish on, because you were talking about banks not lending, and that is risky for the overall economy. What have you made of the kind of quarterly performance that we've seen from the banks as well as some of the large cap IT stocks?
So if you look at almost 37 companies in Nifty have reported till yesterday. And about the earnings growth reported is about 23.5%, which is quite encouraging, though the sales growth has been subdued. In our view, out of those 37 companies, about 30 companies have either reported inline results or above expectation results. So clearly the disappointment in the results till now, still 8-9 days to go, has been less than what we have seen in the previous quarters. But I would like to put a caveat here, that our view is the expectation of the market for next year earnings growth is still lofty. People on the street are still expecting about 25% earnings growth, which in our view is little difficult. We are in a camp of 15 to 18% earnings growth for corporate India next year.
Okay, fair enough. Pankaj, just a quick word before we let you go as to what exactly it is that you're anticipating by way of the traction that we're seeing within the broader markets. We've been talking about how there has been a major recovery, a major catch-up play. Do you think that the broader markets are on course to continue outperforming the index?
We believe so, and we believe that the underperformance which we have seen over the last 18-24 months, where mid-cap and small caps, even after recovery in Jan, are trailing Nifty by about somewhere about 30 to 50% depending on which indices you take. I think there's still some way to go before we change our view. I think if our thought on broader credit crunch start abating out, banks starts taking some more risk, starts lending to the economy, there's no more accident in the financial system for next couple of quarters, I think confidence will start recovering back. But it will be a very gradual phenomena. We are not expecting a V-shaped kind of a recovery anytime soon, but gradual movement will give a lot of confidence to the market participants. And for the last 40 days, it started to reflect clearly on the broader market stocks, where we have seen that many stocks from September lows have given about 30 to 50% return. And we believe that the valuation still looks attractive from a broader market perspective. There are many stocks where the long-term business value is still intact, maybe a couple of quarters of patchy earnings visibility are trading at attractive valuation. So we see that bottom up, there are a lot of opportunities to pick and play in our portfolios.
Thanks very much for sharing with us your outlook on the markets, the broader market recovery, as well as individual sectors that you're monitoring.